something I've been doing now recently is people that are locked into those 5.64s, 5.39s, basically looking at what that penalty is to break out of that current contract and basically renegotiate either with their current lender or with a new lender, absorbing that penalty into, say, a refinance and still getting a better rate and saving tens of thousands of dollars in interest and payments over the next 4 years. You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast. My name is Paul Stevenson. I am a mortgage agent, level 2. I'm joined, as always, by my co-host, David Warren, mortgage agent, level 2, owner at Referral Mortgages. And we are back. We want to just let everyone know quickly before we get into it, if you ever have questions about mortgages, real estate, or anything in between, we're here. We want to help. Reach out to us. Our contact info is in the description below. And Dave, let's get into it. How is your week going? Have you dug yourself out of the frozen tundra?
Kind of. Yes and no. I can barely back my car, barely get my car into the driveway.
Oh my gosh.
Yeah. It's literally a 4-point turn. It was a 4-point turn this morning, just getting my car into the driveway, like in the street.
Yeah, I flew to Toronto, which, you know, luckily there was some scary stuff happened there yesterday, but I flew out on the 12th and it was the wildest scene I've ever seen flying out. I'm not nervous. I never get nervous flying. I was nervous. Like it was, they de-iced the plane for about an hour and then even taking off, it was shaky at best. So I'm here. I'm in beautiful Columbia right now. I'm enjoying it. I'm not looking forward to cleaning my car off at the Park and Fly when I get back. But happy to be here. Happy to be bringing everyone the latest and greatest in Canadian real estate. So, what are you seeing, Dave? What's been going on over there in Ottawa? How's your week? Aside from the snow.
Yeah, that week's been good. Yeah, seemingly everyone that I've spoken to, certainly a lot of people inquiring, and a lot of conversations around buying, but more so in my conversations with a few different realtors over the weekend that of them commenting how busy their March is lining up, that they've been nonstop, been signing listing agreements, and have March, that they're targeting March for a ton of these listings coming out, and as well on the buy side, like, seemingly a 50-50, but these are, not realtors that do a couple of transactions a year, they're in the dozens each. And they're saying that, they're prepping for an absolutely very busy March, at least them. And again, this could be very like a subset, but it's three different like areas of the city. So, but also on the buy and list side. So, that kind of surprised me to hear that they're signing and prepping that many listings for March, given that, as we talked in the last episode, there's so much on the market, or, inventory levels right now are so elevated. So I'm curious to see how that goes. So what people's mindset is as well for why March, is it just that they have a purchase coming up in the summer and they're just getting ahead of it? What the reasoning is for this March timeline? But a lot of the buyers that I've spoken with and seemingly these buyers at these other realtors as well that they're working with have commented that they're expecting rates to come down and market to pick up. And that's kind of what the buyer sentiment is from, without, them hearing from anything from my side or anything like that, or my opinion. It's just that's what they're feeling, is that
you're pumping it, Dave.
Yeah, apparently
you're making them all list their homes and buy.
Yeah.
No, I think when we think back to 5 years ago, right, when these people probably bought these homes, that would have been January to March of 2020, which is when we had the largest number of transactions in the last few decades, right? Or close to, just going off memory. But I know that was obviously a very busy time during the pandemic. So I think all of those people now coming up for renewals are probably considering listing, downsizing, upgrading, what have you. So I've been seeing the same thing. I've been hearing a lot of people that are getting pre-approved, but are obviously planning to list, like existing homeowners looking to either downsize, move outside the city, what have you, now that they're coming up for renewal. So certainly seeing a lot of that. And I have some charts that I wanted to show later, but it seems like across the country, the number of listings that are coming up are just increasing every month, which I guess is kind of to be expected, just with where, a lot of people have been financially suffering over the last couple of years with the increased rates and so on. And we know a lot of people did take variable rate products back then because the rates were, sub 2%. So a lot of those people probably saw their payments increase pretty dramatically over the last 5 years and are now looking to kind of restructure their overall financial picture. So I think we're going to see more and more listings come out, and I'm very interested to see how that's going to impact the market because more listings coming out, rates decreasing, obviously all that tariff talk with the increased cost of builds and things like that. It's going to be a very interesting year, to say the least, as to where things are going to land in, June, July. How do you see prices being impacted by that increase in listings, but also the decrease in rate?
I mean, there's obviously quite a bit of inventory that can absorb buyer demand right now. I think we're in the mid 5 months mark from an inventory standpoint. So there's obviously quite a bit that can be absorbed before really being really driving up the price. But like we talked about last week, and like I even had a client this past weekend lose out on a multiple offer. And I think the same as what we've always said and same as last week is that the places that show well are going to sell. Places that are vacant, and there's one right now I have for a client. For some reason, the seller just doesn't even have the power on in the basement. Like it's vacant, been listed for 6 months, but they don't even have the power on the basement apartment of the secondary suite. Like, why aren't you even having this on? Like, they're lucky that this person even wants to buy this property. It's ice cold, nothing on. I don't get it of why that is the case. But regardless, the properties that are showing well are going to continue to sell. The ones that are vacant, not staged, or not priced accordingly are going to sit longer. So I think it just depends on the mix of properties, the locations of properties of how many get picked up. But there's with rate reductions, we saw it. I mean, the beginning of COVID's a prime example. The reason why there was such a flurry of activity is because rates dropped. And they dropped to a point where it was effectively, free money, if you will. If that happens again, if tariffs do kick in, not only the 25% on March 1st, but then also the steel and aluminum on the 12th of an additional 25, like that's going to stymie the economy and likely call for drastic rate drops, which, we might think that people are suffering just like we thought during COVID of, people being out of work and that there'd be, suffering and people wouldn't be able to buy. And then there's this crazy flurry of activity. So, I don't think that'll be the case again. If there is tariffs do come in, they have to drop rates, but it's certainly, recent history has shown us that the market can absorb unemployment and still have a flurry of activity. So I think even if there is like a loss of employment or employment rate goes up, like it's still, even like I said, COVID showed us that people still can, if money's cheap, there's still people that are willing to buy and seize those opportunities. So yeah. Like you said, come June, it's going to be very different. It's going to be could be a completely different market.
Yeah, I think, I'm hesitant to say this, but I think it's actually a really good time to be a buyer. Like, I think, with the amount of listings that are going to be coming out, you kind of have the pick of the litter. But again, it'll be interesting to see how long with that amount of inventory, where prices go, where rates go, and how long those days on markets last. Because, it's great to have a lot of selection, but if the really beautiful ones are getting all of the attention, if they're getting 80% of the attention and the vacant homes are getting 20% of the attention, the 80% is going to get all of the offers, right? You're going to have 10 people bidding on the same home because there's so many listings, but the nicest ones are obviously going to get the most activity. So that we'll probably see a very large contrast between those turnkey homes that are probably going to have multiple offers and then the vacant homes that maybe need a little work that are going to be sitting for months, right? And maybe getting sold below asking price. So I'm very interested. Like, I really don't, we always say we wish we had a crystal ball, but this is one of those times where, I'm hesitant to even make predictions because I really don't know where things are going to go. I'm just kind of taking it day to day and, things are moving quickly. Like, as we said last week or 2 weeks ago, there was no tariffs, then there was tariffs, now they're adding, now they're delayed. And like everything just seems in flux. There's elections happening in the province. The national elections could be happening in the coming months. There's just a lot of things in flux and all of these things impact the market. So with the, robust amount of inventory that are coming out, the number of listings, as you mentioned, that are kind of being signed and prepped for March, the amount of people being pre-approved, the rates decreasing and likely decreasing even further, the amount of renewals coming up this year, like it's very interesting. I'm hesitant to say exciting, but it's it's exciting.
So I was going to say, if you're coming up with the pricing, there was a comment on last week's episode, almost to that. Why are prices up if active listings are way up and sales are down? You would think that if supply is up and demand is down, that the laws of supply and demand would result in lower prices. What am I missing here? I think, and I know you responded to it really well, kind of, in short, but really what we're seeing is price, places are sitting. So yes, there's a lot of inventory, but those properties haven't transacted yet, and they're not moving because of they're typically overpriced for what, how they're showing. And so those lower prices haven't been recognized by the market, whereas, the places that are going for premium, they're going for that higher price point or the over ask or multiple offers. And so those prices are being recognized by the market and being logged for statistical purposes. But that average price point will likely come down unless something really does change from a demand standpoint once those other properties have to reprice at a lower rate, that'll kind of start to balance out.
Yeah, this is from the Canadian Real Estate Association. If you can see this on the screen here, it shows inventory of homes for sale in Canada. So this is active listings on MLS across Canada, number of units seasonally adjusted. So you can see it's creeping up. Like there's a huge, basically a lack of inventory during the pandemic, sort of from 2020 to 2022. And it's just been creeping up ever since then. And you can see it continues to rise. And I would imagine we're probably going to hit that 200K mark come March, right? As you said, if that's just, we're looking at a microcosm here in Ottawa of, the 3-4 realtors that you were speaking with. But I have to assume that's happening everywhere. That's not just Ottawa. That's not just Toronto. That's happening everywhere. The other chart that I had here that I wanted to show, this was actually in Vancouver. So again, this is Greater Vancouver new construction apartment unsold inventory. This was care of Steve Saretsky, very good resource on X, formerly Twitter. Always has really cool charts. So this is available inventory. This is just in Vancouver. Now, obviously, this is, again, like a very small subsect of the country, but you can just see, it's not just Ottawa. This is another, major market here in Canada. And it shows that the inventory, regardless of where you are, is increasing kind of month over month and quarter over quarter.
I think the new construction is going to have a challenging, the new construction in general, and we talked about last week, is going to have a lot of issues with not only the inventory sitting on the market, but also the build costs and how they're going to also forecast, if tariffs come in. We're kind of back to COVID. It almost is like COVID pricing again for them, where they're having to account for these increases in prices that they weren't expecting and don't know how long it's going to last before they kind of come back down. So I think new build is going to be very challenging.
Yeah. So I actually had two articles here touching on that. The first one was from Financial Post. It says home builders warn of brutal blow to housing sector from steel aluminum tariffs. So I'll just read a quick summary here. It says the Financial Post, discusses the impact of recent U.S. tariffs on steel and aluminum imports from Canada on the Canadian housing market. In February 2025, the Trump administration imposed a 25% tariff on Canadian imports, including essential construction materials like steel and aluminum. This policy aims to pressure Canada into enhancing border security and addressing issues such as illegal immigration and drug trafficking, which they have started to address already. In response, Canadian Prime Minister Justin Trudeau has indicated that Canada would implement countermeasures if the U.S. proceeds with these tariffs. The imposition of these tariffs is expected to have several impacts on the Canadian housing market. The first would be increased construction costs, as you just touched on. The tariffs raise the prices of imported steel and aluminum, leading to higher expenses for builders. These increased costs are likely to be passed on to consumers, resulting in more expensive homes. The second would be supply chain disruptions. The tariffs may cause delays and shortages in obtaining necessary building materials, potentially slowing down construction projects and exacerbating the existing home shortage. And then the third one would be affordability challenges. So as construction costs rise, home prices are expected to increase, making it more difficult for potential buyers to afford homes. This situation could further strain the housing market, especially for first-time buyers. Now, one thing to think about there with the affordability challenges is it's twofold, because home prices go up, but as the rates come down, it helps people afford even more, which would then, again, just push prices even higher because people can afford more. So for those really nice turnkey homes, if people can afford more, they're going to be able to pay more and be willing to pay more if that's what the market dictates. So yeah, very interesting. Again, as I said, I'm kind of at a loss. I really don't know how to interpret. There's almost too much data and too many things in motion that could impact things that it's very hard to predict where things are going to head.
There's way too much uncertainty for anyone to give that, that kind of certain crystal ball answer of where everything's heading. And I'm I don't know. I think really the biggest impact overall is going to be to the market is going to be whether these tariffs kick in or not.
Mm-hmm.
Like that is going to have hands down the biggest impact, because that's going to stymie new construction. It's going to, but at the same time, it's going to drop rates, because the Bank of Canada, it's going to slow our economy down from a supply standpoint, make it more costly. And they're going to have to, I would imagine, and they've said they're going to have to drop the overnight lending rate very quickly, and probably further than they would have done if they hadn't kicked in, and then that plays into that demand side and where that kind of drives things. Regardless of, it's kind of it's like a foregone conclusion that the Bank of Canada is going to drop the overnight lending rate by a quarter point in March, more than likely, and by July have it drops 2 quarter points of 2 drops of a quarter point, and that's what the consensus of the economists in Canada have outlined. I think it's 28 economists that were polled, and they've said that they were expecting kind of a half point between now and I think it's I want to say it's like July or something like that. But that's not going to really push the market like tariffs coming in, a significant drop and a significant impact to our economy.
Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big. Protect what matters most. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal.
I just sent you a link on WhatsApp it was a Canadian Mortgage Trends link, I think, and it actually had that chart which shows the major banks and what their new predictions are basically for the overnight rate. I believe that the headline states that they're expecting at least 2 more drops this year, which I think is very conservative, in my opinion. Oh, there it is. Perfect. So this chart shows basically the 6 major banks, BMO, CIBC, National Bank, RBC, Scotiabank, TD Bank, shows their current policy rate, and then it shows what the kind of expected rate is by, Q1, Q2, Q3, Q4. So it looks like the biggest drop is TD is expecting another 3/4 point drop. And most lenders, RBC actually a full point down to 2%. Most are expecting
the end of the year
anywhere from 3/4 points to another half point, which would definitely, that puts variable rates in the high 3s.
And there's kind of an asterisk at the bottom here. This assumes, of this chart, assumes no U.S. tariffs, expected policy rate of 1.5% in the event of tariffs. So
right.
we're at 3% right now. That would be a full 1.5% drop in the event that there's tariffs, is what the big 6 are indicating.
Which could put prime at 3.7, which if you're getting even a half point off of that, you're talking low 3s then for variable rate. Not quite COVID, but definitely lower than we've seen in a long time, in the last couple of years. Yeah, very interesting. I found that very interesting. The other thing that you were talking about, housing starts, I was reading an article this morning that talked about housing starts up 3% in January, But again, touching on the trade risks that could add significant uncertainty as we've been obviously talking about. So it just says in January 2025, Canadian housing starts increased by 3% from December, reaching a seasonally adjusted annual rate of 239,000 units, according to CMHC. This growth was primarily driven by an 8% rise in multi-unit urban starts, notably in Quebec and British Columbia. Montreal experienced a significant 112% year-over-year surge in housing starts, while Vancouver saw a 37% increase. Conversely, Toronto faced a 41% decline due to decreases in multi-unit projects. That's pretty wild. Despite these gains, CMHC's Deputy Chief Economist, Tanya Barasa Ochoa, cautioned that potential foreign trade risks, such as possible U.S. tariffs, introduce significant uncertainty to future housing constructions. These trade challenges could elevate inflation and prompt the Bank of Canada to adjust its key policy rate, potentially leading to a recession and might delay the housing market's recovery. So everything we're saying is coinciding with each other. They're all connected. But I think everyone's in agreement that there's just a lot of uncertainty, David. A lot of uncertainty out there.
Yeah, I mean, the one certain thing is, and based on this chart of all six of the big banks, is that Bank of Canada is going to drop prime. Like that is basically the only certainty. It's just to what level. It's kind of what the only thing out there. Like, don't know where prices are going to head. Don't know what's going to happen with the demand, with the inventory levels necessarily, and don't know what's going to happen with tariffs. But one thing is for sure, it's that we're going to see we have downward pressure on the Bank of Canada, on bank prime, but it's just a matter of to what levels. I kind of transition that into what you and I do best of on the mortgage side is kind of looking at or kind of where the conversations lead as far as right now, where people should be leaning. I know, a year and a half ago, a year ago, 3-year fixed is what a lot of people were looking at and hedging based on rates being elevated and, not wanting to lock in for a 5-year and lock it at that elevated rate and kind of play that middle game. But now, and I would imagine your conversations are similar, most conversations have gone the other way back to variable or even and into the adjustable rate mortgage conversation. And as we've explained before, a variable rate product is like a TD Bank, for example, has a static payment, meaning that as rates go down, your rate adjusts, but your payments stay the same, just like if it goes up. Banks like monoline lenders like MCAP or Strive or First National and other big banks like Scotia, theirs are adjustable rate mortgages. So as rates come down, payments come down and adjust as well. But I find my conversations have been on almost, I'd say 90% of them are back to variable rate conversations, and not in the fixed rate game, being that variable and variable rates are basically on par. I don't know if you're seeing the same thing.
Yeah,
Nice.
people the strategy right now that people are very intrigued by is taking the variable rate, kind of riding that wave down, knowing that it's almost a foregone conclusion. Like there's no real indicators that could drive that overnight rate up currently. Now, with the variable rate, you can convert it into a fixed rate at any point. I know we talk about this, but just to reiterate, so if you have a variable rate today and a year from now, you can convert that variable rate into a fixed rate. So if the fixed rates come down, which could very well happen as well, you can kind of ride the wave down on the variable. As you said, they're almost on par right now. So if the variable rate goes down another half point, you're sitting in the kind of high threes. Then if the fixed rates come down, let's say, they hit 3.99, you can say, okay, although the variable rate's still lower, we want to convert this into a fixed, kind of lock it in for another 5 years or what have you. So that seems to be something that people are very intrigued by. They want to they're willing to take on some, I say rate risk, but as we said, it's fairly certain right now that we're going to see further drops. Not a guarantee, obviously, but they're willing to take on that, minimal rate risk to potentially benefit from locking in to a lower fixed rate in the future. So that's certainly a conversation that's happening way more now than it was over the last couple of years. Previously, it seemed everyone, like nobody was going to take a variable rate at a 1% higher than what they can get on a fixed rate. It just didn't make any sense. It made no financial sense to do that, unless, again, you had a crystal ball and knew it was going to drop substantially. But even then, you were still probably better off to take the fixed rate. And something I've been doing now recently is people that are locked into those 5.64s, 5.39s, basically looking at what that penalty is to break out of that current contract and basically renegotiate either with their current lender or with a new lender, absorbing that penalty into, say, a refinance and still getting a better rate and saving tens of thousands of dollars in interest and payments over the next 4 years. Because, we saw the peak of rates probably about a year and a half ago, and a lot of people kind of got stuck in that mid-5 fixed rate. And now there's options where they can break that and, pay the penalty out of pocket, which I've seen some people do and get a really low rate, or absorb that penalty into a refinance, get a slightly higher rate, but still much lower than what they have now, and still come out ahead in the next 4 or 5 years. So a lot of very interesting conversations with existing homeowners, but also people that are getting pre-approved that are more willing to take on that variable rate risk, in quotes, versus, even 6 months ago.
Yeah, I had that exact conversation with a client who is 1 year into a 3-year. They're at that higher fives right now, I think 579, 589. Penalty is going to be $15,000 to break based on because rates have come down and it's an interest rate differential or IRD penalty. In order to absorb that, it's an insured mortgage, so it was purchased with the minimum down payment. It still makes sense to do a cashback mortgage to absorb that penalty of $15,000, and they're still going to be ahead by the savings on that, which is a little bit of a higher rate because they premium the rate to build in that cashback. And they're still, as an aggregate, going to save $25,000. So the penalty would be 15, so they're still saving 10, and that's going from a fixed to an adjustable rate mortgage. That is a cashback component, so that penalty can be absorbed, and they're going to be able to ride that downward. Like that additional $10,000 above the penalty is savings based on today's rate on that variable versus what they currently have on the fixed, without it going down another, like we saw in that chart, another half point to even another 1.5%, and then obviously those savings are exacerbated. So if you're in a higher interest rate penalty, certainly reach out to Paul or I. We'd be happy to help you with those numbers and crunch those numbers to see whether, what that penalty would look like, how it could be absorbed, or what strategies are there to get you into a different product or a lower rate that makes sense, and not having to be out of pocket, even if it is an insured mortgage where you don't have that equity to refinance. There are still ways in which it can be absorbed into that mortgage. So certainly reach out to us because we can kind of lay it all out for you as far as what that breakdown looks like.
Yeah, and it's usually pretty black or white. Like, in some of those cases, you look at it and say, okay, you're only going to save, $3,000 over the next 3 years, probably not worth it. But in some cases, it's glaring. Like, you're talking tens of thousands of dollars. It's an absolute no-brainer to restructure it and take advantage of those lower rates. Lots of charts today. I like it. I'm a chart guy. So I'm very happy to have the visuals today. How do you feel, David, about sliding into the mood boosts?
I feel pretty good about that.
Anything else you wanted to touch on before we slide in?
No, let's delve.
And I have to say, go Canada. We got probably one of the biggest games in Canadian hockey history coming up. It'll be tomorrow when this airs, and I'm very excited. I wish I was in Canada to watch it, but
that game Saturday night was just. I know nobody's probably listening by now, so it doesn't even matter. We could talk about it. That game on Saturday was just one of the best games I've ever seen. And the hilarious part of having the NBA All-Star game kind of, or a skills competition going on at the same time. This is like the NHL's All-Star game this year. And it starts out with 3 fights as like their, kind of in replacement of their All-Star game. Absolutely hilarious. It's so good.
Yeah. So much national pride for the sport. And what's funny is we lost that game and it was still one of the best games I've watched. So just so much talent. But looking forward to that. So go Canada.
Thursday.
Hopefully when we chat next week, we're winners.
Okay, so whatever this tournament is.
Yeah, whatever it is. Yeah, exactly. Okay, so I got 3 boosts today. So I tried to start at number one. I tried to start a bakery, but my plans were half baked. Now I'm just loafing around. I'm embarrassed by that one. Number 2, why did the calendar go to therapy? Why did the calendar go to therapy? Because it felt too much pressure to make every day count.
Okay. Well, I mean, that's a little bit more redeeming.
And last but not least, I told my pillow all my problems last night. It just told me to sleep on it.
Okay. I don't mind. I don't mind that.
Shut up and sleep on me. Yeah. Thank you for everyone who put up with us today. We were kind of, when we came on here, we were both, we were both basically a bit overwhelmed with everything that was happening. So I'm happy that we were able to put this together. But thank you, David, for showing up and being here. We try to bring the best and the latest and greatest in Canadian real estate. But we want to give a quick shout out as well to our sponsors. Gertin Poirier Avocat Lawyers, an amazing real estate law firm. Big Insurance in Westboro. If you need insurance, home insurance, car insurance, talk to Brian. And last but not least, Centum. They're the umbrella that Dave and I are both under. They're an amazing network. And if you're a mortgage agent, you're looking for a change, give Dave a call. He'll give you the scoop. So thanks, everyone. We'll be back next week. Go Canada. See you later. Deuces.
Anderson.